Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler. I'm a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, the third in a four-part series on position adjustments, we'll focus on puts. When should you consider rolling? How can it help your position? We'll take a look at these and other questions in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Put Adjustments, Rolling with the Market, Part 3. Joe?
Hey, Nick, thanks so much, and thanks to everybody for joining us again. Good to be back. I'd like to thank Kyle Graham for given the last presentation. I guess that was the 29th of July. He offered a presentation on historic and implied volatility. So if you didn't get a chance to check that out, please do on demand. And as Nick said, I would just reiterate, we really, well, first of all, we really appreciate you being here. But at the same time, those surveys are really important. I think it's 6 or 7 questions. If you could, just take 30 seconds or so to fill them out, we would greatly appreciate it. And that helps us a great deal with future planning. So real happy to be offering part 3 of what will be our 4-part series. I think the 4th part we'll offer on the 30th of September. And tonight we're going to talk about long puts and rolling long put positions. We started, on the flip side with rolling calls. We then get into rolling a covered call position, and tonight we're going to focus on puts. So again, thanks for joining us. I think everybody is aware that we do have something called characteristics and risks of standardized options. That's the options disclaimer document. Please, get a copy of that if you haven't from your broker or from us here at the OCC. Many of you, we know through the surveys, about half of you are new to the OIC and the other half are repeat customers. Many of you know that these are the exchanges and, of course, the OCC in the bottom right, the members of the OCC. These are our funding members who allow us to create this content and bring it to you throughout the course of the year. Here's our, the snapshot of our industry volume from the beginning of the industry back in '73 to, through 2013. And, what strikes me is obviously there was great growth in the industry from 2000 to say 2009 or 10. And then we've kind of been flat around 4 billion contracts annually, a little over 4 billion, which, equates to 16, 17 million contracts a year. But especially over the last couple of years in a relatively low volatility environment, it's pretty interesting that we've been able to sustain such high levels in the options industry. So there are lots of folks using the listed options product, and a lot of them are rolling, which is what we're going to talk about tonight. So we'll go through, just some things, obviously, that many of you already do in our introduction. We'll start with an initial position, and then we'll talk about 5 different adjustment types from a particular initial position. What I'm going to do a little differently tonight that I haven't done in the first 2 parts of our series, certainly, we talk about the new break-even points, but I really didn't focus, I don't think, enough on how we figure out those break-even points. So we'll do that twice tonight throughout the course of the presentation. I hope that'll add a little clarity in terms of, okay, I do a roll, what's my new break-even? Have I put more money into the pot, or have I taken out a credit? So we'll get into that too, and then we'll just wrap it up, with a couple comments as well. So as we get started, knowledge, discipline, and flexibility. Actually, these first couple slides I really kind of like quite a bit. Knowledge is just simply common sense, doing your homework. And as, I think many or all of you know, it comes down to having an opinion on the underlying to then move forward and pick the best option position. So, we want to do our homework. Discipline, of course, all good traders have discipline. I was fortunate enough, to be down on the trading floor in Philadelphia for 23 years. I like to think that I have some discipline, and that's what allowed me to stay there for 23 years. And with discipline comes planning. Where do we get in? Where do we get out? Things like that. So your knowledge, your discipline, and then also flexibility. Flexibility both from a cash standpoint, you don't want to be down to your last dollar if at all possible, and then flexibility in terms of exactly what we're speaking tonight. What happens if your position goes against you, if your forecast was wrong? What type of flexibility and role might we consider? Again, common sense when we talk about opening a position. Of course, the more complex your option positions may become, there are different levels of approval that are required from your broker, so you want to be aware of that. Again, selecting the underlying begins with a forecast. To me, that's part of the fun. For those of you who have listened to me on some of these previous webinars, I'm a chart guy. I really enjoy the charts. To me, that's how I derive my forecast for an underlying. I'm a big believer that those charts, I like to call them the universal snapshot of supply and demand. And so I create my forecast by going to the stock chart, and then from there, based on my opinion, and one of the great things about options and investing, 3 choices. The underlying goes up, it goes down, or it goes sideways, and with each of those choices, we have a myriad of option different positions that we can employ. So that's how I approach it, and not to say that you have to do it that way, but that's my approach. After we establish the position, certainly I spoke to it a little bit earlier, that whole discipline about when do I get out, when do I also take a profit if things are going my way, what type of adjustments. These are different questions, and as we get better at our option knowledge, those answers come more quickly. They're not always just the right answer necessarily, but the choices do come more quickly. And of course, when it comes to any investment, risk reward is key. Understanding from the beginning what my worst case scenario may be. And I think Nick may have pointed out a little bit, we've got just great tools on the OIC website, that position simulator. If you haven't used it before, at optionseducation.org, go to the drop-down bar for tools and resources. Something like the position simulator will tell you your worst case scenario as you get into maybe more complex option strategies. And again, I would just reiterate that last bullet: no best strategy for bullish, bearish, or neutral forecasts. There are lots of different choices. I'm a huge believer that each of us listening tonight have different levels of risk tolerance, and those levels of risk tolerance define quite possibly what option strategies you should be considering. So that's really where I start. What is my tolerance for risk? And from there, I go to my particular underlyings, come up with a forecast, and then employ different option strategies. Another management tool certainly is the whole idea of getting out. Things have gone awry, I'm getting out. That gets back to planning. If you know in advance where you want to get out, that is just going to save you a lot of capital over time. And as we'll get in tonight, the different possibilities of rolling, whether we liquidate a portion of the position, which I think will be the first one we do, and then talking about rolling up, rolling down, and spreading. One thing before we get into the position and the rolls themselves is this discussion of pin risk. For those of you a little bit new to options, pin risk, when you sell an option, any option, whether it's call or put, you potentially have an obligation to either deliver the stock or buy the stock, depending on whether you've sold a call or a put. Pin risk is when we get to expiration, if we're short that call or put, we may, because we've taken in money and sold the obligation, we don't have control. It's the long side of those positions that has the control. So pin risk is the possibility of being assigned. And so when we've got in the money options at expiration, there is no question that we're going to be assigned in the money options. But when we have options that are right at the money, and if we think conceptually about many of our option strategies, at expiration, oftentimes the optimal point for that underlying is right at our short strike. If we think about, so many different types of strategies, to be at that short strike is the best spot. And when we are right at the short strike and those options are at the money, we've got the potential for being assigned. And assignment means we have to, again, either deliver the short stock or purchase the long stock. And if that's not an acceptable outcome, we've got to manage that position and close it down. So that's just something that we need to consider in terms of our options plan and management of that plan. So let's get started with tonight's position. We're going to start with a bearish forecast on OIC's favorite stock, XYZ. Stock currently at $70. Our forecast is bearish, and we really expect this stock to tank pretty aggressively over the next 3 months or 90 days. And we'll start in May. So we're going to have a May 70 put position. With 90 days till expiration. We're going to buy 10 of these puts for $4. So I think everyone knows each option corresponds to 100 shares of the underlying. So there's a $100 multiplier. So we've got that $4 times 100 times the 10 contracts. We'll be committing $4,000 to this bearish position on XYZ. And this is how it looks. You can see the hockey stick on the left side. We've got a break-even point of $66. For those of you who are new to options, let's go through that. We're long the 70 put. 10 of the 70 puts for $4. The put option, of course, is the option to sell the underlying. So we've got to take that $4 premium and subtract it from the $70 strike to give us our break-even point of 66. And you can see that chart on the right will tell us, as the stock goes up, we've got the potential to lose up to that 4,000, but no more than the 4,000 that we've committed, and that's if our forecast was incorrect and we didn't get out before the puts expired out of the money and with no value. On the flip side, if we're correct and the stock heads south over those 90 days, we stand to have a pretty significant return depending on how far the stock falls. So that's the first position, the initial position to get us started into the idea of rolling. So let's go to scenario number 1, stock down. Stock goes from 70 to 62. Our target is for that stock to go to 60 over the 90 days. So, down to 62 is a pretty good move already. But we're still looking for more, and we've got 4 weeks to expiration. So we are, still bearish, but a little bit cautious because, we've already seen a lot of this move, and of course, time is passing by. So we've been right in our forecast, and now how do we manage our investment? Well, our action we decide to do, because we've been right and these options have increased significantly in value, we decide we want to sell enough contracts to cover the $4,000 investment. So we want to cover that investment, and with the stock now down at 62, we're going to make the math easy. We've still got a couple weeks to expiration, so even though these $70 puts are $8 in the money, there should be, probably a little bit of time premium, on top of the $8. But to keep the math simple, let's just say those 70 puts are trading for 8. If we sell 5 of those 70 puts, 5 times, the $8 is going to give us that $4,000 less commissions. Will basically leave us with 5 quote-unquote free puts between now and expiration. We basically don't have any break-even because we did break even, and we've got these 5 puts to see what happens with over the course of the next few weeks. So there's our initial investment. We know that 4,000 minus 4,000 was the initial cost, and we know that at this point we've got that 4,000 back in the account. So going forward, we are long essentially 5 free, if you will, May 70 puts. If the stock tanks, we're going to make considerably more money. And if the stock, the only way we don't make some money is if our forecast, the underlying has a significant reversal and the stock rallies to over 70 at expiration. And if we let those puts, expire worthless, then we would have broken even. But, the idea here, and I used to do this many, many times on the floor, take some chips off the table. That's what we're talking about. And in this, particular example, we took all the chips off the table. We were right in our forecast, and now we've got, 5 free puts. And again, managing those puts, it's not to say that you just take those 5 puts and forget about them. You certainly want to keep a real close eye on, the underlying, because if your opinion on the underlying happens to change, then it's time to possibly get out, put that profit in the bank, and move on to the next opportunity. So that's scenario 1. Let's go through scenario 2. Stock down, target not met. Again, forecast has been darn good. Stocks dropped from 70 to 63. We've got a significant amount of time left, 6 weeks to expiration. But again, one of the great things about trading the markets, it's so dynamic. We get news all the time. Option prices fluctuate, implied volatilities fluctuate all the time. So here in scenario number 2, some negative news has come out on what we already view as a bearish underlying. So now we're more bearish, and we lower our $60 target price. So we think the stock's going to head further south beyond 60, and we think this is still going to happen within the same time frame, within the next 6 weeks. So the action we decide to take is to roll down to a lower strike. So remember now, we're on the put side. We bought 10 of those May 70 puts for $4. By rolling down, we're going to roll to either the 65 or the 60 puts. And of course, our objective in doing that is to two things. I mean, we have to decide whether we're going to roll down and still commit the same $4,000 investment. That's decision number 1. And then number 2, how bearish are we? How much leverage are we looking for? We're going to roll down from those 1070 puts. Obviously, if we buy 65 puts, we're going to be able to buy more than the 70 puts that we own. And if we roll down even further to the 60 put strike, we're going to buy considerably more options. So that gets into the whole question of, how bearish am I? How far do we think this stock's going to fall? If we're extremely bearish, it's in our best interest to have as many long puts as possible. And that's where this whole idea of roll comes in. So again, the consideration is capital on the roll. We'll go through a couple examples, and then where my break-even point is after I do this roll. So let's start with the 65 puts. We sell 10. Now we've got 6 weeks to expiration. So rather than those puts trading for $8, we've still got 80 cents a premium in those puts. So we get to sell 10 of those May 70 puts for $8.80 each. We take in $8,800. To roll down to the 65 puts, those 65 puts with the stock trading at 63 are going for $4.90. So we could buy 17 of those 65 puts and still take a little money off the table. So you can see the math, 88 less the 83.30. We put $470 in the bank already. That 470 is from that original $4,000 investment. So we would have $35.30 on the table, and now have 17 of the 65 puts as opposed to 10 of the 70s. So that's where the leverage comes in. If we decided we wanted to put more money aside, maybe we do 14 puts, 13 puts, whatever, but that's that decision on capital that each of you needs to make individually. Again, if we're more bearish, and that's really the scenario here, we could roll down to the 60 puts. And if we're to do this for even, we'd sell the 70 puts for the $8,800. We could buy 37 of these May 60 puts that are trading for $440. That would leave us still with, a $4,000 investment, with the stock at 63, and we are 6 weeks to expiration. Over the next couple weeks, unless that stock really starts to hit the skids, what are we going to be getting nervous about? Well, I would suggest, it's going to be that theta, those May 60 puts. Unless that stock really starts to go, they've still got $2.40 a premium in them. That theta is going to be pretty significant. So you really got to have a strong conviction that that stock's heading south and going to do so pretty quickly. So they're the two, roll down scenarios out of the original position. Buying 17 of the 65 puts and taking a few dollars off the table, or buying 37 of the May 60 puts at $240 each, and that's going to leave us still with our $4,000 investment. So that's our original position and its break-even point. If If we roll down to the 65 puts and buy 17 of them, we'll get a break-even point of just below 63. And I will go through that calculation with you not once but twice tonight. And then lastly, again, if we roll down to those 60 puts, we got lots of puts. You can see how steep that line becomes. So if that stock drops hard, there's going to be significant reward. But at the same time, if it doesn't, that theta is going to start to potentially eat us alive as we get close to the expiration. But getting back to that earlier point, all of us have different risk tolerances. And depending on your level of risk tolerance may define whether you roll into a 65 or a 60 put, or as we'll get into some of the other examples, you may roll down and out at the same time. So let's go over the calculations. Okay, here's how we calculate. Maybe some of you have pen and paper, but again, as Nick said, you can always come back to the presentation on demand. The way we do this is to calculate the new break-even point after the roll. Basically, we take our net investment amount. So the net investment amount is either going to be $4,000 or the $3,350. We are going to divide that amount by the number of contracts in the new position. And then we're going to divide that number by the 100 multiplier that comes with options. And from there, we subtract that number from the new strike. And whether we have done it for a debit or a credit, again, in our example here, we're going to be starting with either the 33, I think it was a 3530 number, or the 4,000 divided by the number of contracts, divided by 100, minus the new strike. So minus the 65 strike or minus the 60 strike. And that's how we get those break-even numbers. Here's how we look, and this is why we consider rolling. If we start, top left at 75, you can see, those May 70 puts. If the stock were at 75 at expiration, obviously our forecast, our bearish forecast on XYZ would have been incorrect. So anywhere from 70 or above, we would have lost our investment. But as we go diagonally down to the bottom right-hand corner, you can see if we were correct and that stock continued to tank and went to $50, we would have been far better off rolling down to those 60 puts because of the additional downside leverage that we would gain in short deltas by owning 37 of those 60 puts as opposed to 10 of the 70s or even 17 of the 65s. So, that's the whole point of rolling. And, the challenging part in the option space for me was always what strike, what month. They're the two questions that oftentimes, until we get to expiration, you obviously don't know the answer, but honestly, that's where some of the art and some of the fun comes in, trying to figure out exactly what is the best month and strike when it comes to rolling or even just to initiating positions. So that was scenario number 2. I hope you have that. Let's go to number 3. Stock down again. So we've been pretty good in our forecast. This time, not quite as aggressive to the downside. The stock's declined from 70 to 65. We started with 90 days. We've got 3 weeks to expiration, so we're getting fairly close. Our target price, which was 60 from the outset, remains the same, but with only 3 weeks to expiration, we're nervous, and we want to buy some time. So our choice is to roll out to a further expiration. So let's see what we do. To extend that time frame, we decide to roll, as I said, just roll out, not down. So we're going to roll those May 70 puts out to June 70 puts. Getting back to that capital question, if we're going to roll from May to June, obviously that additional period of time is going to cost us some money. I think we decide that we want to do this thing for even or a net credit. So common sense would tell us obviously we're not going to be able to be long 7 of those June puts. It's going to be something less depending on the price of those options. So we will have, from a risk-reward standpoint, our break-even point will be a little lower, and we'll have a little bit less downside profit potential because we'll have less leverage because we own fewer puts. But, we decide our 4,000 was the max we're going to commit, so we're going to roll out to June, and we're going to do that with fewer puts. So the June 70 puts, with the stock at 65, they go for $7.50 each. The May 70 puts, still with 3 weeks to expiration, they've got $1.20 worth of premium, so they're going for $6.20. So we decide we're going to take $950 off the table and buy 7 of the June 70 puts after selling 10 of the May 70 puts. So that will, again, we started with an investment of $4,000. If we put $950 in the bank, we're down to $3,050 of a net investment. And now we've got 7 of those puts, but we've got an extra 4 weeks of time to have our forecast down to 60 be correct. So there's our original position and our break-even point at 66. Our new break-even is going to be 65.64. Again, we take that new amount of capital outlay, which is the $3,050. We divide that by 7, and then divided by the multiplier of 100 minus our strike. Now the strike is the same at $70. That's going to get us to our 65.64 break-even point. And here's how it looks. We can see, if you go real quick down to the bottom, you can see if we hadn't rolled and we still had 10 of those May 70 puts in at expiration, the stock completely fell out of bed and went to 50, we obviously would have made more money than had we rolled to the 7 June puts. But, that's the art of investing. That's where the art comes in how we manage our positions. And of course, the top side of that bar chart, if our forecast was incorrect, clearly, we're going to lose some money because we were incorrect. But difference being, with the May 70 puts, we still had $4,000 on the table. Having rolled out to the Junes, we put $950 away, and so our maximum loss potential there, if we turned out to be incorrect, would have been $3,050. But I would hope, if we've got a position on like this and the stock turns and starts to head the wrong way, rather than marry these positions to expiration, you certainly have an opportunity to either close them out or do different forms of adjustment so that entire investment of either the $4,000 or the $3,050 isn't lost at expiration. Let's go to scenario 4. Stock down, target met. So again, wonderful forecast. Stock, heads down the entire $10. Still, we've got about 30 days to expiration. So those May 70 puts with 30 days, now they are $10 in the money with the stock at 60. They're $10 in the money, so there's not a lot of premium, but we've got 30 days to expiration. So we've got 50 cents of premium, so those May 70 puts are now trading for $10.50. We're more bearish, as it turns out, for the next 60 days. So we've got a target lower than $60. We decide we want to extend our time frame. We want to roll down and out to a lower strike. And I hope these choices are making sense to you as you move along with your options knowledge. These will become second nature. Rolling, putting money back in the bank, taking my chips off the table, and leaving free options, whether it's call or puts. Rolling down, rolling out, rolling down and out, or spreading, which will be scenario 5. These hopefully will become like second nature for you. So we're going to roll down and we're going to roll out. again, the objective is to have more leverage and buy some more time. That all-important capital decision. What am I going to do? Am I going to put more money up? Am I going to take some off the table? Here, again, I want to do it for either a net credit or even money. So let's take a look at how this plays out for us. Rolling down and out. So originally it's the 10 May 70 puts. We're going to roll down to the June 65 puts and out. Excuse me, down and out to the June 65 puts. So we sell those 10 May 70 puts with the stock at 60. We take in $10,500. That gives us the opportunity with the June 65 puts trading at 750 to buy 14 of them. So if we do that down and out roll, that turns out to be even money. That means we've still got $4,000 on the table. Another choice would be, again, for more leverage. We are more bearish, but with that, we get lower break-even points. The stock sits for a while. We've got greater theta. But if we roll down to the June 60 puts, we take in that $10,500 by selling the 10 May 70 puts at 1050, and by rolling to the 60 puts that trade for 450, the June 60 puts, it gives us an opportunity to more than double the number of contracts. We get to buy 21 of them, and with that, with them still trading at $4.50, we get to put or take over $1,000 of that original $4,000 investment off the table. So if we roll down to 21 of the June 60 puts, our total investment is going to be that $2,950 rather than the $4,000. So again, the original position, we know our break-even point was the 66 level, which was the 70 strike less the $4 we paid for those puts. Rolling down to the 14 June 65 puts will get us a break-even of 62.15. And again, that calculation is the $4,000 divided by 14 divided by 100. And the new strike is 65, so we subtract that number from 65, gets us to that 62.15 break-even point. And then to roll down to those June 60 puts, 21 of them. Again, less money on the table, so rather than starting with a 4,000 number, I think it was a 2,950 number. And you can see that on the left-hand side of the slide. That's our maximum loss. We take the 2,950 divided by the new number of contracts, 21, divided by that 100. Minus the 60 strike, that takes us, that's $1.40, takes us down to the new break-even of 58.60. So that's rolling down and rolling out. Our that basically is that same calculation. So if you get back in here on demand, you'll have two opportunities to see exactly how we calculate those new break-even points and P&Ls after the roll. I hope I'm explaining that clearly for you. To the upside, if our forecast is wrong, you can see we've got less risk potential rolling out to those June 60 puts, because we took over $1,000 of that $4,000 investment off the table. We've still got a $4,000 max loss in the 65 puts, lower break even, but now the stock, above 65 at expiration would cost us that entire investment total. And then, of course, if we stuck with the 70 puts, we know above 70, we're going to be out that investment total as well. But again, you can see heading down to 50 or 45 in this chart, you can see where, we gain some leverage by owning more options, and of course, less pressure on us by rolling out to June. And, that gets back to how much conviction do we have in our forecast in the underlying, and what is that balance between how quickly you think that can happen and the theta amounts that that naked long position may cost you overnight. So our last scenario is going to be scenario 5. Again, stock down. We're darn good forecasters because once again our forecast has been met. Stock is going from 70 to 60, but we've still got 60 days to expiration. Now, many of you may be saying, I got 10 of these 70 puts. I bought them for 4 with 30 days to expiration. Stock at 60. We know intrinsically they're worth at least $10, and there's going to be some time premium because there's going to be some value to that 70 put with 30 days left. So they're going to trade for 10.20, 10.30, 10.50, somewhere in that neck of the woods. Buy them at 4, sell them at 10 or 10.50. It's a heck of a trade, and I think most of us would take that trade in a heartbeat, maybe every day of the week. But let's go through another potential scenario just in case you have a bit of a different forecast. And so if our target's met and the stock heads down $10, maybe we feel the stock is just as the forecast on the slide suggests, we're now neutral on this underlying to expiration. So we don't think the stock, we're neutral. Stock's going to wallow around the strike. So we decide to spread the long puts to create a bear put spread. And so a bear put spread, we know we've already got the 10.70 puts. We're going to decide to sell the 60 puts and put us into that $10 vertical bear put spread. And that $10 vertical put spread can be worth how much at expiration with the stock at 60 or below? Well, $10 differential between the strikes means, at 60 or below, that vertical spread's going to be worth at, $10. So that's why if our forecast is neutral here, we decide to, put on this 70-60 put spread basically with the idea of taking advantage of time decay. And that's really the motivation here, trying to make additional profits rather than just that $6 plus whatever premium was left with the stock at 60 with 30 days to expiration. So let's go through that a little bit. If we sell the current puts at $10, we paid 4. So again, if there's no premium, and we could profit and make that $6,000, but if we create this put spread, again, we bought the May 70 puts for $4. These May 60 puts, still with timed expiration, and the stock here at 60, they're trading for 2. So we're able to put on this 70-60 put spread for $2. So if we put it on for 2, again, simple math. One of the great things I love about options, so much of it is straightforward and simple math. If we got a $2 debit on a spread that can be worth $10, the most we know we can make here is an additional $2. And we'll go through the spread here. There's our break-even point on the original 10 May 60 puts. And why is our break-even point on this 70-60 put spread 68? Well, our break-even point because we paid $2, as it turns out, for this $10 put spread. And you have to subtract that debit from the highest strike on the put side. So it would be the 70 minus the $2. The $2 debit gets our $68 break-even point. And as I mentioned, we could, rather than in our example, if we had just sold the May 70 puts for 6 with no time premium, we could have made $6,000. The idea here is to potentially make another $2,000 with our maximum profit potential being $8,000 or $8 in that vertical spread. So that's the point of putting on the vertical bear put spread, trying to take in an additional, in our example here, a couple $2,000 additional dollars. Now, the risk is that stock turns around, takes off, and to the upside, and you give some money back. But again, our forecast is we think the stock is tanked $10. We think it may hang out in this $60 strike level over the next 30 days. That's why we decide to get into the spread as opposed to just taking our profits on those 70 puts. That's the rationale. And here are a couple different, spread scenarios. The May 70 puts, obviously we're long 10 of them. We're going to continue to make money as the stock goes down. If we get into the May 70-60 put spread, rather than just holding those May 70 puts, we know our maximum profit potential is the $8,000. But of course, we have less money on the table, and our break-even point is lower as well. In terms of the long, if we had sold the 60 puts or the 70 puts, our maximum profit there would have been $6,000. As I've said a couple times, the whole motivation towards putting on this spread around a forecast where the stock is just going to languish at 60 over the next 60 days is to make those that additional couple $1,000 with a maximum profit potential of $8,000. So there are 5 scenarios. I hope they make sense to you. I hope that calculating the break-even point is clear. Again, just to reiterate, we take our, after any roll, we take the new investment amount, divide it by the number of contracts, divide that by the 100 multiplier that we have with all the options, and then we subtract that number from our new strike price. So that's that's how that break-even point, and we calculate after these rolls. So there are the 5 scenarios. Couple other things. Again, a lot of this is common sense. After we establish a position, we want to monitor it. We mentioned volatility very briefly, but implied volatility is the measure of how much the market expects the underlying to go or to move in the future. The higher that expectation, obviously, the higher our premiums are going to be. And depending on whether you just own calls or puts or whether you have spreads, you're going to have different long and short volatility positions. So just monitoring your position from a P&L standpoint, but also from an implied volatility standpoint makes a lot of sense. I mentioned that pressure that many of us feel with theta. Always err to more time rather than less in the option space, because we know that options do have a shelf life, and as we get closer to expiration, those long option positions can hurt an awful lot if our forecast hasn't been correct. I think just risk reward, of course, is important. I mentioned just as a last thing, the 2 decisions when we're rolling, one of the real important ones is the capital commitment. In our example, we started with a capital commitment of $4,000. When you roll, you can take some of that money off the table, or you can increase it, or then do it for even. So do the numbers in terms of how much additional leverage you can buy when you roll down and or out, and then how do you feel about your forecast? Do you feel like you want to take some chips off the table, or leave that same investment still going forward? But that's the decision that we all have to make individually. And just very last slide here, rolling either with a credit, a break even, or a debit. And if we were to do a debit, then we have to add those break-even points to the various strike prices, figuring out our break-even points. So I think, Nick, that's it. I think folks know optionseducation.org is our very interactive and I hope many of you think very excellent website. 888 Options is our expert team of investor services support. They're there 5 days a week to answer any one of your option calls, and we're lucky enough to have the group from Investor Services presenting some of these webinars. We'll have Bill Ryan next on the 9th of November, and also, if you've got an iOS device, you can check out our OIC mobile app. So, Nick, hopefully we got a few questions.
We do indeed, Joe. We got a couple of really good ones. And ladies and gentlemen, I do want to reiterate what Joe said. If we're not able to get to your question today, please call our investor services team. 888 Options. They're there. They're experts, and they're ready to help. So, Joe, to start the questions off, one of the things that you mentioned during, I think it was scenario 1 or 2, can you explain a credit-debit put spread?
Sure. Let's start with a put spread. Okay, there are lots of, by put spread, I guess we're talking a vertical put spread. Let's go back to our $70 strike that we used all night tonight. So if we want to buy a bearish vertical put spread, we're going to buy the 70 put and sell the 65 or 60 put, or we could, sell the 55 put too. But if the stock's at 70, the value of that 55 put, which is $15 out of the money, is going to be pretty insignificant. So if we buy the 70 put and sell the 65 put, the terminology would be long the bear put spread, long the 70-65 bear put spread. And because the 70 put is the option to sell stock at 70 versus the 65 put, which is the option to sell stock at 65, the 70 put's going to cost more, so we're always going to do that spread for a net debit. Okay, and basically we're getting long the 70-65 put if we start talking about delta and position because the 65 put has more value than the 70 put has more value than the 65 put. There's going to be more delta to the 70 put, so that's what gets us short deltas. Going back to what I talked about earlier with when we talked about the 70-60 put differential being $10, in this example, if we paid, let's just say we paid 2 for the 70-65 put spread, if the stock at expiration dropped below 65, the maximum that spread could be worth would be the difference between the two strikes, or $5. So if we paid 2, it's worth 5, we make 3. That's owning the bear put spread, the 70-65 put spread. That's a debit. On the flip side, Nick, if we sold the 70 puts and bought the 65 puts, we'd be short the 70-65 put spread, and really flipping everything I just said, we would then be long deltas, and because the 70 put has a greater value than the 65 put, we'd actually take in those $2 or $200 if you use the 100 multiplier if we sold the 70 puts and bought the 65 puts. And that's true on the call side. And I think, Nick, maybe one of our very early webinars went through the 4 different scenarios of vertical spreads. We've got bull call spreads, bear call spreads, bull put spreads, and bear put spreads. The vertical spreads are wonderful strategies. They are risk reward defined, meaning you know what your max loss is and your max gain. And for those of you who aren't familiar with vertical spreads, check them out on our website. I know we got lots of information, and they are wonderful building blocks in terms of building your knowledge base. What's next, Nick?
Joe, thanks for that. And before we get to the next question, I want to let our listeners know that all the different previous sessions that we've run on our webinars are available. What I would ask that they do is contact our investor services team, as I mentioned, at 888-OPTIONS. They'll be able to email you a link directly to the previous webinar that you'd like. We're working on putting a video library together, but that's not quite ready yet. So in the meantime, feel free to reach out to our investor services team. They should have the links ready to go and should be able to help you out. We've gotten that question quite a few times, so I want to let everybody know. Joe, the next couple questions we have are about slide 24. I'm going to push this to the audience right now. We had a couple questions on this. First one is, if you have a bearish view on the stock, why don't you sell calls and then use the proceeds to buy the puts?
Well, for however many hundred of folks who are on our webinar tonight, we may all have a different approach. Now, certainly somebody could sell calls, but you know, the question was about selling calls to finance the puts. Is that right, Nick?
Correct, Joe.
Okay, so when we sell calls, let's not forget, you know, we always have to be thinking in terms of ultimate risk reward. If we sell calls, what's our risk? It's unlimited. So yes, we may finance, you know, our puts to the downside, but essentially we're doubling up. And we're doubling up with unlimited risk to the upside. So, you know, for me personally, that's not a strategy that I would take. I would be more inclined to definitely do it a different way, and that would be, you know, either depending on, you know, my capital base, my opinion of the underlying, you know, I would either just be long puts, I'd be, you know, long vertical put spreads. I could now, and this is not, let me see, Darren, I think in October, another one of our investor services experts, Darren Tate, in October, will give a presentation, or actually that might be November, a presentation on diagonal spreads. That's, excuse me, not diagonals, but back spreads. And back spreads allow you to sell options, but actually buy more of, you know, whether it's a call or a put, you buy more options. So let's go back to our $70 stock. Maybe we decide to sell the 70 put, but buy more of the 65 puts. So if this stock really tanks, yes, we've offset, you know, some of the cost of the 65 puts with the 70 put, but we're long considerably more of the 65 puts than the 70 puts. So as the stock continues to go down, you know, we've got the leverage of those long puts. So a back spread might be another option, but just selling calls to finance the puts, from my perspective, just carries way too much risk.
Joe, I'm really glad that you asked about the interaction there between the 70 puts and the 65 puts, because the next question that we had on this slide 24, could you keep the long 5 May 70 puts and establish a debit spread and then sell 5 of the 65 puts?
So basically, I think just talking about rolling down, and absolutely, and really that is just like scenario 5 that we talked about, Nick. If the, you know, in scenario 5, the stock, the forecast was right, the stock went to 60. Not sure where this particular listener's underlying is, but let's just say that stock, you know, has gone down, but isn't at 60, maybe it's in the 65 range. Absolutely, you can roll down or just turn that 70 put position into a vertical spread, long the 70 puts, short the 65s, and it would be the exact same motivation that we went through in the 70-60 put spread. You know, if the forecast is maybe that the stock's going to hang out in that 65 range, we're going to take advantage of theta. So that's a very solid approach towards, you know, hedging that 70 put position.
Thanks, Joe. A lot of the other questions that we had are very applicable to actual trading. I think people want to get their hands dirty and actually get into the markets rather than just learning about it.
Let's do it, Nick. Come on.
Yeah, we got to learn how to trade here. So, how would you look at options, good options to find? And while we can't give specific recommendations, how would you find good options to find with high volatility and high volume for use in trading these options? Where are good places to start looking for those?
Well, good places. Most, if not, I can't say all, but most brokers offer wonderful tools where you can go in, you can define the level of volatility and then volume, and they will send you a list of things. The OIC site is populated by a firm by the name of iVolatility. I know they have different tools that do cost some money, but they have different tools. It's important that people know maybe that we have most actives, a list of most actives, both individual stocks, ETFs. That's on the site. They can find the most actives. Now, the most active options doesn't necessarily mean that they're high volatility. I find it interesting that the question spoke to high volatility and high volume. High volatility typically means more risk. So, be aware of that. One other thing I would suggest is rather than just chasing high volatility underlyings or underlyings, that have options with high volatility, go back to your handful of favorite stocks. Get familiar with those stocks' volatility, the implied volatility. And I think, for our regular listeners, you can find those historic and implied volatility charts under tools and resources on our site. I live by those charts. And, know how much the implied volatility range is for your favorite stocks over the course of a year. Those volatility charts that we carry, Nick, do give us a 1-year range. So, just another consideration might be become somewhat expert on the volatility ranges of your favorite stocks. And so, have some confidence when the implied vol is at the high side versus the low side in those underlyings, and then maybe employ certain strategies, based on, if the vol's to the high side, do some strategies where you sell implied volatility. And if the vols are to the low side, maybe consider long volatility positions. So there are lots of different tools out there. You could simply Google high implied volatility stocks, and I'm pretty sure a number of different firms' tools will come up when you Google something like that. But just one last thing, Nick. High volatility, high implied volatility often means higher risk, and just be prepared for that.
Thanks, Joe. Well, we are a few minutes over our 60-minute time. I think we have time for just one last question. But before we get to it, I want to remind our listeners that if they haven't done so, they can fill out the survey. As I mentioned, it's very helpful for us to guide all of our future webinar programming. So if you haven't had a chance to fill that out, we'd greatly appreciate it if you were able to. Joe, last question of the day here was maybe one of those it depends sort of situations, and it might have something to do with the different brokers that these investors are using. But can a trader roll a spread under one transaction, or does he have to first close the initial position and then open a new one to make that happen?
We start with our initial position, and then it rolls. So it's not like we start with those 10 May 70 puts. We don't close that and then start another position. That's a simultaneous roll, and that's how it works, Nick. We basically well, I mean, it could be done on a legged basis. So it would be two separate trades if you decide to close the one individually and then open the next. But I think the more efficient way is to do it as one spread trade, depending on whether you're rolling down, out, or into a spread. Do it as a spread trade.
Thanks so much, Joe. Do you have any closing words for our listeners today?
No, I don't, Nick. Just thank everybody. Appreciate everybody joining us, and look forward to our next webinar.
Ladies and gentlemen, thank you so much for listening today. As Joe mentioned, the Position Simulator on the OIC website is a great resource for you to use. It's under the Tools and Resources drop-down on our site. Again, today's session will be archived and should be accessible in a few hours using the same link as you used to join us today. As Joe also mentioned, thank you so much for your time this afternoon. If we weren't able to get to your questions, give our Investor Services team a call at 1-888-OPTIONS, available during most business hours to answer your options questions. We'll be holding our next webinar on September 29th, when we'll have Bill Ryan from that Investor Services team, and he'll be talking about the topic of diagonal spreads. Make sure to check optionseducation.org or keep an eye on your email in upcoming weeks for details. You can sign up at any time. That registration is currently live. Ladies and gentlemen, thank you so much for attending, and we hope to see you again next time.